Lloyd, most important things that you would like practitioners to leave today's webinar with from your piece of the presentation?
Sure. I think that, really right now it's a big picture time. So take a look at the top 12 developments and focus on the ones that most impact your business or clients. I think the other one is the way the 20% QBI deduction works. I think that's very important. So take a look at that flow chart and see if it helps you you understand or wrap your head around all the moving parts in that.
Alexei Manizweb, it's your turn.
Thank you, David. I think I'd like to share a few points. One, and that relates to reduced corporate income tax rate. In the international tax context and cross-border transaction context, a lot of people now are looking into using corporate solution for investing in the U.S. or restructuring certain investments to use the corporation. And that may be a viable strategy. I would, however, mention, and Mark discussed some of the limitations, such as NOL limitation, such as interest expense deduction limitation. There are other limitations that may not necessarily make that change as helpful or ideal. It all depends on facts and circumstances. You should also note that 21% is federal income tax rate. On top of that, states typically add tax rates anywhere from 5 to 9% roughly, and there are states that don't have income tax rates, so that obviously would only limit it to federal rate. But the tax rate in itself is very helpful, but it should not be the only guiding principle in structuring your U.S. investment or corporate investments into the U.S. And the second point I wanted to mention, and I fully agree with Mark here, I think at this point you need to keep the general picture in mind, and you need to be patient because the IRS and Treasury will issue additional guidance. The law is being understood. You need to pay attention to the effective dates of different provisions and the sunset provisions for individual and qualified business income deduction dates to make sure that any planning or structuring you do can be reversed or changed without adverse tax consequences to the extent in the future it becomes irrelevant, or if the law changes after 2025.